Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding partners of the Dividend Kings marketplace subscription service on Seeking Alpha. This is part 2 of my series on principles of sound valuation. In part 1, I talked about answering the important questions when to buy or when to sell a stock. I'm going to elaborate on that, and I have elaborated on that a little bit in part 2, but I'll be elaborating on it even more in this Analyze Out Loud video, because what I attempted to establish in part 1 was that the best time to buy a stock when valuation is sound, or at least an optimum time to buy it is when valuation is sound, even better when a stock is undervalued. So in order to accomplish that, you have to have some ability to assess or be able to calculate what fair value is. Now, by the way, the words fair value, intrinsic value, true worth, all of those are simply attempting to identify a valuation level that is sound and prudent, and most importantly, a valuation level that will empower you to participate in the growth of the company. But one of the things that I think, at least my experience tells me, has really confused many investors in this subject of what is fair value is not understanding the difference between present value and future value. Because present value is all about, again, soundness and prudence. And it is very possible, and I'm going to show you 2 examples of that here in this video, to have 2 companies with significantly different rates of growth or earnings growth rates, and yet have the same essential present value or prudence valuation currently. And it really has to do with what I call earnings yield. Now, one of the barometers we use to measure that, of course, is the PE ratio. And I also want to point out that I'm applying this conceptual concept to all metrics, whether it's cash flows, earnings, etc. It's all trying to identify how the business is performing as an operating company. That's really what we're trying to accomplish here, because this is all about investing in the business and not playing the stock market or playing stocks. But when I make investment decisions, I want to make sure that I'm making the decision when it's sound, number one, but I also want to be sure that I'm positioning myself to fully participate in the company. Now, as indicated in the written portion of this article, when you're dealing with a low-growth stock like a utility like Southern Company, and I want you to see here, what I've got is earnings per share, the orange line on the graph. This is the dividend line, by the way, and showing that they pay out a very large portion of their earnings, but I'm not focusing on dividends here. I want you to focus on earnings and earnings growth rate. Now, this orange line represents the PE ratio of 15, which I articulated as kind of a base valuation reference line because it represents an earnings yield of 6.67%. Or let's say, keep in mind this is ish. It's not 15, it's 14 to 16 or something of that nature. If I put the normal PE ratio on this graph, as you'll see when I add price to the graph here in a moment, that the normal or average blended or trimmed average PE has been about 16 for Southern Company. My theoretical fair value calculation is 15. And we'll test how that works out in the real world here in a moment. But the point is, this company has 3.33% growth rate going back to 2003. So the slope of this line, which is the second important aspect of this line, it's actually sloped at 3.3%. If I move on to my faster growing company, which is AmerisourceBergen here, you see a very similar situation in that you've got a PE ratio, a fair value reference line of 15. That's the orange line in this example is also a PE of 15. Incidentally, as I'll show later, the normal or average PE over this time frame is 15.9. That's another 15, 14 to 16, if you will. These are ish numbers. Always think of these as ish numbers. But the point is that the slope of this line is significantly different. In this case, AmerisourceBergen has grown almost 4 times faster at 12.5%. So the slope of this orange line is obviously much steeper or higher. The point being is that when I'm trying to determine fair value, if I'm trying to make a decision when I should buy the stock, what I'm going to try to illustrate here is I want to buy it when the PE ratio is 15 or lower, because that's giving me at least a average or normal earnings yield or return on my invested capital represented by the company's earnings, and it's positioning me to participate in the company's growth. All right, so if I add price to this graph, the first thing I want you to notice is these are monthly closing stock prices, is that this 15 PE ratio does in fact in the real world become a baseline valuation reference. If I look at this graph and just, looking at picture here, guys, if you just think about what you're looking at, If I buy it at a 15 PE, it constantly reverts back to that. When it gets above the 15 PE, it eventually drops back. When it gets below the 15 PE, it eventually comes back. We got really above the PE here. It eventually came back, and we're seeing that even at a much more rapid rate here in the last 4 or 5 years. We see this up, down, but this PE becomes my baseline sound valuation. Now, buying it when it's below the orange line is optimum, or the best I can do. But the key is to recognize that this represents fair value for the company and to acknowledge that it does so here in the real world. Now, when I go back to Southern Company, once again, we see the same thing. We see a 15 PE ratio, even though we have a much flatter growth rate here. So it's going to generate a different long-term rate of return. The point is I keep getting this above the line, back to the line, below the line, back to the line, above the line, back to the line, and so on and so forth. So the point that I'm trying to get across here is that a 15 PE ratio, which represents a 6.67% earnings yield, is a good baseline valuation reference. It's something that you can think about and say, hey, if I can buy this company, no matter what its growth rate, at about 15 times earnings, I'm probably making a rational or a sound decision. Now, my rate of return is going to be very different. So I've also mentioned several times that the idea is that when you buy a 15 PE ratio, you participate in the growth of the company. So here, I'm going to run the calculation where I go from a 15 to a 15. Now, the PE that I'm buying it here or marking it here is 15.3. The ending PE is 14.92. Both of them roughly 15 times earnings. And what I want you to notice here is that your rate of return is going to be essentially in a line with what the company produced. Here I get a 6.3% rate of return for a 3% grower plus a 4% dividend. That's about what I would expect. Now, if I bought the company when it was cheaper, like at the throes of the Great Recession here, and held it again to about that same PE ratio, now my rate of return balloons up to 9%. In contrast, if I bought this slow growth company up here at, say, an 18 PE ratio and held it when it reverted back to PE, my rate of return is only 2.9%. However, I also want you to notice this company is currently very overvalued, and that's the market value, not the intrinsic value or the fair value or the true worth value. That's this orange line here. And this orange line helps you make sound decisions. This is clearly not a time to be buying a low growth stock like Southern Company. Now, if I go back to AmerisourceBergen here on this graph and look at it differently from a standpoint of a much faster grower, I still get this 15 PE ratio as a sensible, prudent, rational valuation multiple. There's my 15.39, and I hold it to where the company was trading again. I'll get 15.63 there. Let me do that again. I missed it. I go to 15.39. Now I'm at 15.6. Here I'm getting a 15% compounded rate of return instead of 6. The difference is the future value is going to be a function of how fast this earnings line grows. But the present value is something that all companies have in common, because I mentioned in the written portion of this article that even a no-growth investment like a 10-year Treasury bond has a value that's more than its interest rate. So if I go to my earnings yield chart here, I want you to see a 10-year Treasury bond here in this example. The point is, if I bought a 10-year Treasury bond, this is rounded, 1.8%. I think it's currently 1.78. This is 1.83 when this graph was drawn. I'm getting 183, 183, 183 every year on an original $10,000 investment. That's the nature of a Treasury bond. Okay, that's a fixed income investment. But the point is, this 1.8% yield in this example that I'm showing you here sells at a multiple of that interest, and that multiple of the interest is over 50 times interest, which makes, as I mentioned, bonds very, very expensive. Now, if I look at Amerisource here, getting back to answering the question when to buy, I don't want to buy Amerisource when it's overvalued. And forget about peaks and troughs, because we can't really identify those except in hindsight anyway. But if I'd have bought it here at a very high multiple, a PE of 22, by today, some 3-4 years later, I'm losing money on this stock, including my dividend. I'm losing a $10,000 investment's only worth $9,977. I actually lost 7.5% 9.6% of my money over this time frame because I overpaid. Now, even though the company grew earnings at a pretty nice rate during this period of time. So this idea of valuation is about soundness and risk. But I also talked in the article about the notion that fair valuation doesn't necessarily ensure that you're going to get a good rate of return. So let's look at this retailer here. And let me take price off for a moment just so you get the picture. Here's a company that still I'm drawing the earnings of this company with that same baseline 15 PE ratio because it is a measurement of soundness and prudence, statically, not taking any consideration into the growth. So when I put price on this graph, monthly closing prices, I want you to see, just like we did with the other two, a slow growth and a fast growing company, you get this relationship in the real world now, in the actual results, which you're seeing on this graph here, that 15 PE ratio keeps rearing its ugly or beautiful head depending on which company you're analyzing in this group. But again, we keep seeing that reversion to that 15 PE ratio simply because it's a sensible and a rational valuation level. So the point is, so far, is that what you want to do when you're making a buy decision is make sure you're buying the stock at a valuation 15 or lower where you're going to, at the minimum, participate in the full growth in the company and optimally maybe really get some, tremendous additional return because you'll get PE expansion in addition to the growth. Now, I didn't really talk too much about dividends. The two that I'm primarily showing you here do pay dividends. And so when you look at long-term performance, for example, Amerisource during this time grew at 12.52%. It's a little undervalued. The growth averaged just under 10%. I got a dividend. I made 10.6%. The point is I've participated in the growth of the company, but the market's discounting that growth a little bit at today's valuation. In contrast, if I go back to Southern Company and look at Southern Company over this similar time frame here, and I'm going to get rid of that anomalous earnings there, I'm looking at a 3.33% grower, and I look here and I get a 4.7% growth rate plus dividends, balloons it up to 7%, but a significant portion of that return is functionally related to the fact that I've got a PE of over 19, almost 20 right now, which I consider to be very highly valued. This stock reverts back to the mean within the next year, and you're looking at a 23% potential drop in the value of the stock. And that makes sense to me because looking at analyzing the real world, that's always happened every other time the stock has gotten significantly above its earnings line. Now, in part 3, I'm going to be talking about future value, and which I've introduced here in this part 2. But anyway, this has been Chuck Carnwell. I hope you enjoyed this. I hope it gave you some more insights into why a 15 PE ratio is a measurement of soundness, but not necessarily an indicator of what your rate of return is going to be. You have to add the other elements, for example, earnings growth and dividend income, etc., and how fast the dividend grows to get that sense. And we'll talk about that more in part 3. Thanks for watching. I hope you enjoyed it.